วัสดีค่ะ
ครับ
Distinguished guests, ladies and gentlemen, welcome back to the second day of BOT Digital Finance Conference 2022. With us, Kun Bok and myself, Pami, truly honored to be here today. So yesterday we touched upon the idea of responsible innovations, that we could leverage innovation for productivity, resilience, sustainability, and inclusivity. And for those who missed yesterday's schedule, the recordings will be available soon after this event.
Well, today we are going to tackle a lot of hot issues that I trust many of you are waiting for. But also for those of you joining us on site, the library stage and the exhibition areas are still ongoing. So please feel free to check it out. So for the first session of today, two extraordinary speakers will be having a fireside chat on a very hot topic, digital assets. We'll talk about the good, the bad, and the future. Joining us half the way across the world, Chief Strategy Officer and Head of Policy at Circle, Mr. Dante Disparte. And here with us on site, Chief Executive Officer and Chief Venture and Investment Officer at SCB 10X, Ms. Mukhaya Panish. Please give them a warm welcome.
Thank you so much, everybody, for joining us today. I'm Thai Panish, CEO and CIO of SCB 10X, the digital technology investment arm of Siam Commercial Bank, which is the biggest and oldest bank in Thailand. And I'm very excited to have with me Dante Disparte, Chief Strategy Officer and Head of Global Policy at Circle, with us. Yeah, thank you so much, Dante, for joining. And let me introduce Circle real quick. So Circle is leading digital financial services company, and they are building very interesting things in treasury and payment infrastructure for the internet, including the leading stablecoin. It is the second largest stablecoin with the market cap of $50 billion in circulation right now. So very, very interesting. And before Dante came to Circle, he actually used to be at the DM Association. He was the founding executive member of DM Association, which you guys all probably know that it's the stablecoin payment system of Facebook. Yeah, so Dante, do you want to say anything in addition to the audience?
Well, other than to say it is an honor to be on a virtual stage with you, and hopefully the next occasion I can be in Thailand in person. But I'm grateful to the Bank of Thailand for hosting this conversation, and of course very grateful to you to have this fireside chat today, which I'm very excited about.
No, that's great. So today the topic is going to be about digital asset, the good, the bad, and the future. And let's start then. So financial industry has always been changing due to the technological force, and the latest of which is digital asset. So today we are going to explore the topic of first thing, what the future financial landscape will look like with digital asset. And then second thing, it will be about what are the advantages and the opportunity and the challenges that digital asset bring. And the third thing will be about the future regulations landscape. Yeah? Okay. So let's talk about payment. Payment is the most basic feature of financial services. And Dante, I think in your previous interview, you talk about payment is the bottom rung of the ladder of economic mobility. Yeah. If we actually looking at the global landscape, we have seen so many countries already that have implemented quite successful digital payment system, with little to no cost to the user, and also close to real-time payment at their fingertips. And I think Thailand is a very good example of that because we have PromptPay that the user can make payment, can make transfer with zero cost and real time. And then we also see that the recent pandemic has sped up the adoption of digital payment globally. So my first question to you is that, with all this that happening, do we still really need another innovation in the payment area? For example, on-ramp money, programmable payment, do we really need that? And what are the advantages that digital asset bring to payment? Is there any disadvantage at all? And also, what are the use cases that you are thinking about?
Yeah, well, I think one of course, starting point is healthy competition is always a good thing. And even in environments where you have an efficient domestic payment system or an efficient domestic financial access, you could still envision a world in which innovation in payments still remains very meaningful. And so in my analogy, where the bottom rung of financial mobility is to be able to pay people efficiently, the other rungs on that ladder are different forms of financial services that are made possible once money becomes programmable. And so in a world where digital assets are not only here to stay, but I think in many jurisdictions around the world becoming increasingly well regulated and increasingly trusted, then the next step, once you can pay people efficiently in an auditable manner and in near real time, is to then open up this idea of programmability of money. So if you think about where in the world is there friction in financial services, it's oftentimes in more advanced financial services that require intermediation. And you could think of a whole host of use cases. Insurance, for example, is one category that today, even in very advanced economies with high penetration of insurance, the beneficiary of an insurance policy has the burden of proof to show the insurance company that they are in fact a legitimate claimant to money. But in many cases, the evidence that they were insured may have been destroyed in a disaster, a hurricane, a typhoon, a flood, etc. And so a form of insurance that could exist denominated in digital currencies, payable through a device, an internet-connected device or a wallet, is a type of insurance that wouldn't be possible unless you had trusted forms of electronic money that could be paid in a programmatic manner. So that's just one example of one of the benefits that even in a country like Thailand that might have very, very deep innovations and fast, instant, and near-free payments, that you could envision other advantages from continuous innovation in this market.
Got it. And of course, with Circle and USDC being known as very popular stablecoin, regulated fiat-backed money, in your opinion, do you think that right now we have way too many stablecoins in the market? What's the balance between competition and fragmentation of liquidity due to too many types of stablecoins?
Yeah, first of all, it's a very good question. And I think we learned the hard way over the last maybe 90 to 180 days, what the crypto industry calls crypto winter. This time around has been particularly cold and particularly dark and perhaps particularly long. And in that environment, we've learned that not everything that carries the title stablecoin is in fact stable. And by that, of course, I'm referring to the collapse of the algorithmic stablecoin Terra Luna, which was proposing to do something with algorithms and science that the traditional financial system would have called a derivative at best. And so the Terra Luna collapse has in some ways accelerated this idea of financial contagion in other parts of crypto markets and crypto assets, but it also has lent from the lens of regulators and central banks around the world, I think a lot of urgency around what does it mean to, in fact, have a payment stablecoin innovation, what some jurisdictions like Europe and others are calling e-money tokens, and what does it mean to have forms of so-called stablecoins that might not enjoy trust, transparency, auditability, and at best have a relatively loose relationship to economic stability or their underlying reference currency. And so you see right now quite a deep market correction, frankly. And the other piece that I think is really important is today the principal use case for these innovations has been speculation. What some here in the United States might call poker chips in a crypto casino. My point typically is that you could still use in a casino a very fast method of payments. And it's a powerful proving ground for these innovations. And so we think of this as the beginning of the utility phase, where you will see more real world adoption, more retail adoption, and more integration with traditional financial services firms all over the world of better forms of faster transactions.
Got it. And I think that cross-border payment is actually a very good use case for digital asset. In general, right now for Thailand, for example, like I mentioned, we already have like real-time payment system. But for cross-border payment, I think that is something that we can totally use digital asset. Yeah.
Well, and one of the interesting pieces of the puzzle with cross-border payments as a category is if I asked the audience today, do you send a cross-border email? The answer would probably be no. I actually send an email to a trusted recipient of an email, irrespective of where they are in the world. And this is where I think the opportunity of stablecoins and the opportunity of well-regulated on and off ramps, virtual asset service providers, banks, central banks even, become an interesting way of thinking of a world in which money can be transmitted at the speed and the scale and the geographic reach of the internet, but is not encumbered by the traditional boundaries of borders at some level, which of course presents potential challenges vis-a-vis monetary sovereignty and monetary policy, but in some ways also present an extraordinary opportunity for the planet to advance goals of lower cost payments, introduce important competition in cross-border payments today, in which many countries only have a monopoly or a duopoly of providers that deal with remittances. And then the third thing I would ask is, in a world in which the United Nations have set this challenge of the Sustainable Development Goals, the very first of those goals is to eradicate extreme poverty. The question then is, how do we achieve it if part of that strategy has to be lowering the fundamental cost of being banked for billions of people around the world who are on the margins of the formal economy? And so I think of these innovations as laying foundations for new ways of being banked and new ways of transmitting value at population scale.
How about central bank digital currency or CBDC? Will CBDC coexist and compete with the privately issued stablecoins, in your opinion?
Yeah, it's a very good question. And as you know very well, as a matter of fact, the last time I was in Thailand, it was under the auspices of my prior project. And in some ways, I'm on the same mission. I just happen to be in a better company. But the mission is very much the same, which is that responsible actors innovating in not so much the creation of money, because that is obviously a sovereign activity. And that's an activity run by central banks and independent central banks all over the world. The real innovation then is about the rails. And so my analogy on central bank digital currencies is, if you simply contemplate the economic quality of the digital asset, but you ignore the rail network, it would be like creating an amazing high-speed train, but not caring about building the network or the rail stations. And so my view, frankly, is yes, CBDCs and stablecoins and privately issued digital currencies like USDC can coexist, and they very will likely coexist. But it's also very important in economic environments that are competitive and rules-based to ensure that the central banks do not crowd out innovation in the private sector, including in the two-tiered banking system. And so that balance is, I think, the most important piece to preserve. And so I would envision a world in which you have rules-based competition that is domestic and global, and that the responsible actors will have rail networks for transmitting value, even digital currencies that are interconnected and global.
Yeah, so in your recent interview, Dang Tae, you talk about CBDC is anti-democratic. Can you maybe elaborate on that?
Yes. Well, I have some reasonably strong views about central bank digital currencies. And of course, I say it with utmost respect and deference, not only to the Bank of Thailand, but to all my colleagues and friends in central banking. Is what we have to be careful about is forms of money issued by public authorities that do two things. The first is, of course, we want to protect and preserve the sovereignty of central banking to have oversight over the macro environment and the economy, Adam Smith's invisible hand. However, the second a central bank starts to introduce this idea of a retail CBDC, all the way down to the last mile, down to the end user, it starts to have some potentially long-range societal impacts. And not to mention, they have some potential impacts around rules-based competition in the free market. And so those are the two areas where I think CBDCs pose the biggest risk that could raise some not only anti-democratic tendencies. For example, do we choose to deplatform people for money? Where and how does the money encounter geographic boundaries? Do you have forms of money that are automatically shut off if a device enters a geolocation that might be problematic, and so on? And I think it's important to guard against those tendencies. I also think unless central banks are really thoughtful about the long-range implications technologically, a true CBDC at the retail level has to make a 100-year technology bet. And I don't know if we're ready as a society to place a bet against Moore's law, which is that technology will continue advancing exponentially every single year. And we're still in the middle of a space race in some respects around the technology plus the designs. And before the Libra project was announced, no central bank on the planet was deploying central bank digital currencies. After Libra was announced, and I must apologize because obviously I was a part of that effort, 105 central banks have started to experiment with central bank digital currencies. And of course, China is the largest of the global economies that have rolled out a pilot project at scale. And so I think somewhere between competing with large countries and competing with big tech, there's a middle tech layer, and there's a banking layer, and there's a responsible innovation layer that countries should harness as a part of their digital currency strategy.
How about how would you reassure the small emerging market nations that vary about the risks of dollarization posed by global stablecoins?
Yeah, I mean, first of all, that is such an important question. And frankly, much of the conversation about digital currencies and crypto assets more generally has been risk-based as opposed to opportunity-based. And so I do a lot of work and talks, of course, with the World Bank and the IMF and the UN and other multilateral organizations, including the Bank for International Settlements. And frankly, for the last 5 years, the discussion about digital assets and crypto assets has been risk-based. Emerging and developing markets will suffer digital dollarization, and we will accelerate the erosion of monetary policy and monetary sovereignty in those countries. So goes the argument. Perhaps the inverse is also true, which is that forms of money that can import to devices at the retail level or at the business level hard currencies from overseas faster from diaspora populations from different developing and emerging countries, and beneath the corruption radar and at a cost lower than the fees of a MoneyGram or a Western Union, is also a potential net benefit. Many countries around the world, particularly in Latin America and elsewhere, receive a great percentage of their total GDP from foreign receipts, from foreign remittances, which is a source of hard currency, but it's also a source of alleviating poverty. Foreign direct investment and official government development aid collectively are a smaller number than the total amount of cross-border payments sent by retail individuals or remittances. And so anything that we can do as a society to lower the basic costs and increase the speed and the settlement finality of remittances has greater poverty alleviation benefits and, in my mind, greater economic stability benefits than doing nothing at all. And so that would be my one caution is, yes, there may very well be risks, but there's also an enormous risk in doing nothing.
That's very well. How about let's talk about credit. So the second feature of financial services is credit, and credit is definitely the crux of modern economic growth. We see DeFi or decentralized finance, that people talk about. It is a novel concept that is trying to disintermediate the existing player with something that is faster, cheaper, more transparent, more inclusive. But then some people also say that this is more of a solution looking for a problem, and some even say that it's a hoax. In your opinion, given what happened in the recent crypto space, we see over leveraging, due to all these like highly leveraged borrowers and speculation from the like of Three Arrow Capital, from Celsius, for example. Does DeFi have a place in credit and lending space?
Yeah. Well, no, first of all, if we're still talking about the latter, the bottom rung is low-cost payments. The next rung, of course, is to think about credit. And there's two things. There's the time value of money, and then there's the money value of time. And if you could get programmable money to work for you, as opposed to you working for your money, then you could basically lower the fundamental cost of a lot of financial services that not only require heavy intermediation, but again, back to my example from the insurance world, where the burden of proof and the burden of trust is on the individual. And so I'm a very, very big believer in DeFi. However, I like to think of it as software intermediated capital markets as opposed to DeFi. Because candidly, a lot of the terminology in crypto not only is scary, but it oftentimes is missing the real, not only output, but also the real purpose of a lot of these innovations. And so I am a very big believer in the concept of programmable features being baked into on top of a layer of trusted digital currencies, financial arrangements that, frankly, if payments has not had competition or evolution in 50 years, then credit and lending and insurance has not had fundamental change or innovation in hundreds of years. And so imagine a world again where the credit worthiness of an individual, and here I'm reflecting on the examples in the United States. Here in the United States, you get a 3-number credit score issued to you by one of 3 credit bureaus, Experian, TransUnion, or Equifax. Equifax had a data breach the size of the entire American working population, more than 150 million people. Those 3 numbers are going to determine your totality of credit worthiness, your lending, and your borrowing capabilities for the rest of your natural life. And so along comes this innovation called DeFi, built on the backs of blockchain-based financial services and built on the fundamental first rung, stablecoins, in which you could program the borrower and the lender being able to consummate a transaction, set the terms of a loan, and have automatic payments of that credit transaction with a very low probability of default because the credit is all visible and the arrangement is programmed. I think we're only in the early stages, even if there have been examples of over leverage and collapse. And this gets to the last quick word on this topic, which is, this is where I think there's frankly a big opportunity for banks and traditional financial services and jurisdictions like Thailand and others to set the ground rules for responsible competition. Because the things that blew up crypto were the same things that blew up traditional finance in 2008. Greed, leverage, fear of missing out. Now at the speed of the internet, of course, you would have very large collapses when these systems fall apart.
How about in the area of decentralized money, decentralized stablecoin, like DAI of the former Terra's UST? And I think recently we have seen quite a few protocols come out with protocol native stablecoin, like Aave and Curve also coming out with CRV USD. Yeah. What do you think about all these decentralized stablecoin? Do they have a place in stable world?
Yeah, well, I think we could argue that there is an importance in being stable, and maybe they don't need the term stable coins. However, that what many of them are built on is this idea. The other big miracle of privately issued digital currencies, there's really three of them. The first is transmissibility at the speed and scale of the internet, irrespective of the sum of amount paid. The second is this idea of programmability that we already covered a little bit in the DeFi discussion. The third is composability. And because most of the underlying technology of true blockchain-based financial services and crypto assets is open source, is that it has sparked a revolution in, and frankly, and I think this is what your organization is all about, it has sparked a revolution in responsible fintech innovation. Because now you could think of the Lego bricks of composable, exquisite, programmable internet money. And so one of the expressions of that, of course, is this category of algorithmic stablecoins. However, the one caveat is I think of algorithmic stablecoins like Terra Luna as a distinct category of crypto assets, more closely linked to derivatives or alchemy, financial magic on the internet, than linked to payments innovations that would be usable by billions of people. And we've learned the hard way. There's a long list of failed algorithmic stablecoins behind us that would argue that this type of innovation is perhaps problematic because you're really running into the very boundaries of economic stability and financial stability with the speed of the internet. So I think of them as a very distinct category, distinct from true stablecoins.
Yeah, I think in earlier session yesterday, one of the speakers talked about stablecoin is the unsung hero of crypto because it's the one that see the most product market fit and actually enable a lot of applications that happen in DeFi and crypto. So my next question to you is that what are the necessary factors so that DeFi can achieve a fully functioning financial system? And in your opinion, do you think that will that be a day that they eventually completely disrupt the traditional financial system? And if that's the case, what will be the opportunities for the incumbent financial institutions?
It's a great question. And I'm not saying this because I'm here under the auspices of the Thai Central Bank and sharing a stage with, or an audience rather, with colleagues from traditional finance. I've actually held for a very, very long time the idea that both blockchain and the internet are foundational technologies. The internet was a disruptive technology, whereas blockchain I consider an augmenting technology. Meaning that frankly, you see it very powerfully shown by JP Morgan and Jamie Dimon's comments on crypto assets, which is that 1 year, if I catch anybody trading Bitcoin, they will be fired. The next year, JP Morgan establishes a division dedicated to digital assets known as Onyx. The next year, Onyx is making real-time payments from Earth to satellites using blockchain-based financial services. The next year, JP Morgan is partnering with Visa to create networks denominated in digital assets and sort of running real-time payments on blockchains. And so if it is good enough as an augmenting technology for one of the world's best run and most capable banks, then I would think anybody in the room who is representing a traditional financial services institution ought to pay very close attention, not to what they say, but to what they do. And so when Jamie Dimon was in Washington talking about these experiments and said crypto and blockchain have no intrinsic value, it was exactly the same time they just hired someone to be their global policy leader for that job. So pay attention to what they do, not to what they say. And the other thing I would say to the room is there have been, at least over the last decade, 3 examples of big mega trends coming that have changed business and have changed markets and have changed governance and leadership and innovation. And at all times, they were initially dismissed. Cyber risk showed up, and the boards thought it wasn't their problem, and it was the IT leaders' problem. Cloud computing showed up, and companies thought it could be ignored, or it was a magic leap too big for companies to embrace. And now digital assets, cryptocurrencies, and blockchain infrastructure, open infrastructure have shown up. And we have a choice to make. Do we either enable it in our countries, regions, businesses, public sector institutions, or do we ignore it? And in my view, if we ignore it, it's going to look like cyber risk, digital transformation, cloud computing before it, that the people who were late and the countries who were late will suffer a competitive disadvantage.
Okay. So next, let's talk about financial inclusion. People talk a lot about DeFi enable more financial inclusion, but we have seen that a lot of DeFi protocols, they actually ask the borrowers to put up over collateralization, and a lot of people also say that people who use DeFi are not really underbanked or unbanked because of high gas fee and things like that, and the minimum requirement sometime on each transaction. And so do you think that DeFi actually can really solve financial inclusion issue?
Yeah, no, first of all, it's a very, very powerful question. And for anybody who has ever heard me say anything on this topic, the thing I'm most passionate about is proving that these innovations can do good for people, especially marginalized communities. But I came to a realization when I had to go defend crypto and DeFi in the Senate Banking Committee here in the United States. And that video is on the internet if anybody cares to see it. But I came to a realization as I was being questioned by hard skeptics that, crypto has failed a financial inclusion test that the traditional financial sector has had a monopoly in addressing. And I sat there and I listened, and then finally it dawned on me that neither a physical dollar nor a real one, neither a physical one or a digital one has agency. And that in order to solve systemic levels of financial exclusion, you need to actually construct a value chain designed to pull more people into basic banking services and so on. And so crypto alone doesn't achieve that. However, what it does do, and this is where, again, the technology analogizes very nicely and closely to mobile internet, that if to reach people with the traditional infrastructure of telephony, fixed lines and posts, to reach billions of people required that type of infrastructure, there would be still billions of people with no access to mobile telephony and the mobile internet. And what allowed more progress to be made on connectivity, we could argue a human right, just like being banked is a human right. It required new infrastructure being normalized by traditional and new players to reach more people. And that's where I think the biggest opportunity for financial inclusion with digital assets, DeFi, and blockchain become possible, is because we're lowering the fundamental cost of transmissibility of payments. And by programming financial contracts that otherwise require the JP Morgans of the world, and by building them into code that are automated and composable and are working in more robust manners, you can now lower the fundamental cost of being banked. But if you don't do it by design to target vulnerable populations and marginalized populations, then you're absolutely right. The technology will be dominated by institutional players who can afford the losses and afford the risks of these initial waves. The last thing I would say is imagine if we told the planet, stop developing the internet because I don't like the dial-up phase and the worldwide wait is terrible. We wouldn't be where we are today, and I certainly wouldn't be on the virtual stage with you in Thailand. So we needed to continue innovating the internet in the same way that we need to continue evolving these blockchains. And the Ethereum merge is a very, very powerful example that the technology is not standing still and is being constantly upgraded, reducing its carbon impact and its climate change impacts and increasing its efficiency and throughput. That's very important.
How about asset tokenization? I think that's the area that has been talked about for some time and a lot of interest. And I think in Thailand as well, asset tokenization, there are many companies that are interested, apply for a lot of licenses. But I think it has been quite slow in terms of the progression in this area. What do you think necessary, for the success factor to happen for asset tokenization to take off? And also, will this better solve the inclusion problem, the financial inclusion problem, because there's fractionalization?
Yeah, no. Well, for one, I think it's been the hardest and most elusive area of digital assets is this idea of asset tokenization, in part because, again, the actors that have tried to do the most work in this space have perhaps approached it in a way too traditional approach, right? We have commercial real estate in New York, and we want to tokenize the commercial real estate in New York. But fundamentally, the transmission of ownership of real tangible assets is always managed today in very, very traditional approaches with a central register that will record on a piece of paper who is the owner, and the deed of trust goes in this paper folder over here, and so on. And so the idea of tokenization of this asset class has been very elusive thus far. But then there is this whole other example of asset tokenization that might at first feel a little like a gimmick. And it's the whole world of non-fungible tokens, or NFTs. Ironically, the innovation in crypto assets that has perhaps had, other than stablecoins, the broadest user base and the broadest adoption is this idea of monetizing digitally scarce creative assets, right? And so I think the NFT becomes the next big proxy for population scale innovation with digital assets. And there's a reason every major company, from traditional brands to luxury goods, are contemplating using NFTs for a whole host of models of loyalty and models of engagement and models of digital scarcity that are quite unique. For example, today people argue that we're in the internet age and data is the new oil. The difference, however, between data and oil is that oil is a finite, scarce resource and geographically bound, whereas data is the world's first infinite resource. And until blockchain showed up, and until tokenization showed up, and until NFTs showed up, you could never, ever turn data into an asset that was scarce. And so I think, so if data is the new oil, I've argued blockchain is the barrel through which you could compartmentalize the oil and begin to monetize it in completely new ways. The inverse is also true, that if my data, the expression, if the product is free, you're the product. If my data was suddenly compartmentalized, and as an individual on the planet, I could choose to permission people in or block them from accessing my information, imagine how I could monetize it. Imagine a world in which big tech companies would have to pay me a micropayment directly for an advertiser to break into my browser window. Without blockchain, without non-fungible tokens, and without this correction on the internet, what people are calling Web3, read, write, and own, that reformulation wouldn't be possible.
All right, well said. Let's move on to the next topic, which is the biggest elephant in the room, regulation. We are all aware that finance is the industry that see the highest regulation. In your opinion, how are we going to balance innovation with the risks to financial stability and integrity?
Yes, well, it is an elephant in the room, and I would say that hurry up and wait is not a strategy. And that for 5 years now, the world has been discussing, central banks have been discussing, parliaments have been discussing, the Senate, the House, and governments have been discussing. And in the 5 years, the discussions about the risks that crypto assets could produce have all manifested themselves. Every single one of the worst things that the Financial Stability Board or the central banks of the world thought could occur have happened. And what has not happened is that companies and projects and developers who have respected the boundaries and have respected the concept that despite the fact that you could execute financial services in code and with new fundamental technology like blockchain and cryptography, those companies have actually not only survived 2 years of the COVID-19 pandemic, those companies in some respects have been one of the few silver linings and otherwise dark clouds around the world. And I think it would be a real shame if those companies and those developers and those investors and those operators continued to look over the entire planet and find no place to call home. Because despite the fact that the Internet of Value is in fact a technology revolution, it still needs homes. And so my encouragement to Thailand and my encouragement to the Bank of Thailand, and this may not be my opportunity to deliver a message to policymakers and regulators, is enable the innovation in your jurisdiction so that the jobs, the development, the economic capability, and critically the technology also is built in Thailand as well. And that's where I think from the White House to the Queen's speech in the United Kingdom to the massive regulation the Europeans have passed, this is now a matter of economic competitiveness amongst nations as much as it is a matter of economic competitiveness amongst technologists, developers, investors, and companies. And I think it's really, really critical that jurisdictions all over the world, like Thailand and others, start to raise a flag and say, we're open for business, but we want to attract the responsible developers and the responsible innovators and not the speculators.
Okay. And how about your view towards increasing regulations to crypto companies, especially in the US, as it's more and more that we see nowadays in terms of regulations? How will this shape the landscape of crypto industry, and how are the crypto companies, should be preparing themselves?
Yeah, well, that's probably the only reason I'm not in Thailand right now, is because, as you can imagine, a big portion of my job is keeping an eye on Washington and trying to encourage the United States to figure out what is the right model of responsible innovation. And despite the noise and despite the news, I've actually never been more optimistic than I am now, that the US, while maybe slow to the party, will invariably help lead what is a paradigm of responsible innovation in this space. And we see it from the Biden administration's executive order on crypto assets, which made a very clear call for leadership on the technology, but also leadership in enabling this innovation. And so I've never been more optimistic. There's also 2 bills in Congress, one in the Senate and one in the House Financial Services Committee, which would capture 2 corners of the market. One of them is a bill on payment stablecoins, which is the world Circle lives in and companies like ours live in. And the other is on this classification of a lot of the digital assets in circulation as digital commodities. And I think those 2 things being passed in the United States starts to allow other jurisdictions around the world to harmonize to a standard, whether it's anchoring to a US standard or developing novel standards of their own. I think that is candidly an area of great opportunity for many countries around the world, is to start being the locations where the responsible actors will coalesce and build these networks out. But I've remained optimistic. I suppose that's how we're supposed to be wired as entrepreneurs. They're Americans and Americans. and I'm optimistic that we will figure this out.
All right. So next is many crypto fans care about not being subjected to governmental oversight and prefer DAO or decentralized autonomous organization. And in your previous forum, you talk about supporting compliance and regulations which require certain degree of all this monitoring and centralization. So how these two ideas work together between decentralization versus regulation and compliance?
Yeah, well, so I've said for a long time now that when these innovations work, inclusion, innovation, and financial integrity should not be seen as trade-offs. And this is why I actually argue that the idea of central bank digital currencies may very well be anti-democratic, because the highest order use of money, whether it's in its physical form or in its digital form, is to actually guard the use and the presumption of privacy of the end user. And so for me, that's the feature that a lot of these innovations have to protect, right? In many countries, a woman shows up to a MoneyGram location to pick up money. She may become the victim of an attack because women are marginalized in a society. In many other countries, and we saw this in the United States, the producer of the Black Panther movies showed up to a bank, asked to withdraw $12,000 from his own bank account, and ended up in handcuffs because he was the wrong complexion in the wrong part of town, or whatever the case may be. And so I do think one of the very powerful aspects of these innovations is the presumption of privacy. And however, the argument of wanting to have privacy should not be seen by regulators and financial compliance authorities as, if you want privacy, then you must be Al-Qaeda, or you must be an illicit actor, or you must be a narco trafficker or a child trafficker. It actually must assume that the erosion of privacy is itself a national and global security vulnerability. And we should be careful as a society on the whole world about honeypots of personal data being accrued for something so basic as financial access. And so I do think this is an area of further development and further societal discussion that is bigger than the digital asset discussion, and frankly, bigger than a lot of the discussions we've had so far. It starts to become whose value systems are going to be ingrained in the code and in the conduct of Web3, of this Internet of Value that we've been talking about. And to presume that anybody who wants privacy in their digital lives is a bad actor, I think, is a flaw, especially because these technologies can combat illicit finance much better than anything we've seen since in terms of banking and anti-money laundering, countering the financing of terrorism and fraud. These technologies work much better than any technology we've seen since in financial services.
Let's talk a little bit more about decentralization. So USDC is a centralized stablecoin, programmable money. And in the past, when Circle got requests from law enforcement, you guys could block or blacklisted certain USDC address from receiving money, from receiving USDC, from transferring USDC in and out of the account. So that's pretty much freeze the money from the account. This kind of underscore how is the limitation on decentralization when it comes to regulated business interacting with permissionless network. Yeah, so my question to you is that, what do you think about this, and will we ever see the full decentralization when it comes to regulated business?
Yeah, it's a very good question. And the example you may be citing is, of course, Tornado Cash. So Tornado Cash, for the audience that may not be following crypto on a daily basis, was a mixing service, what was purported to be a completely free and open software platform that would anonymize transactions. And here in the United States, the Treasury Department's Office of Foreign Asset Control designated Tornado Cash as a money laundering vehicle that had laundered up to $7 billion, including a big portion of that money that was directed to North Korea's nuclear program. And so here's the hard choice, right? Should good technology be co-opted by bad actors? And what is the boundary through which national interest supersedes private interest? There's always a trade-off in free societies between the greater good and individual rights or business rights. And so Tornado Cash in some respects was not something that a company like Circle would equivocate on. And so we did not, and we conformed with the obligation. But the standard through which a company like Circle responds to blocking requests is a standard that is higher than any other digital asset in circulation on the planet. It is responsive to rule of law in the United States and a court order. Those are the two boundaries. And so when you compare Circle and USDC to any other stablecoin in circulation, we're the least blocked digital asset on the planet in that category. Most other instances where a tether may be blocked or other digital currencies are blocked, oftentimes there's no due process, no application of rule of law, and it feels arbitrary in nature where blocking requests may come. The other interesting piece of the puzzle is obviously the role of exchanges and the role of virtual asset service providers and intermediaries in these value chains. Where there is also, I think, an important compliance obligation that exists in the entire value chain of digital assets that's really important.
Got it. And then how about given the borderless nature of cryptocurrency, will we see international regulation framework that are realistic?
Yeah, well, herein lies, in my mind, the greatest opportunity. And hopefully what you see in my conversation tonight with you, or this morning with you, is I'm trying to be a regulatory diplomat. The opportunity is for nations and jurisdictions to harmonize standards and avoid an arbitrage or avoid a race to the bottom in this new segment. And this is where I do think the United States and other countries have to start working together collaboratively around that exact harmonization. Bodies like the BIS, the Bank for International Settlements, the Financial Stability Board, the Financial Action Task Force, have in some ways advanced harmonization and standards for regulating this industry. But in other ways, they've missed the opportunity by being way too preoccupied on the risks and trying to ban an innovation that will never, ever be stopped versus figuring out how to empower countries and jurisdictions to enable it and to bring it on shore. And so I think that to me is some place, an area of work where I feel hopeful. And I know events like this one are a part of that process of bringing multiple stakeholders together, having conversations. Equally, next week in Singapore, obviously the Singapore FinTech Festival brings this debate on the stage in Asia. And I think this is a big opportunity area, is to figure out how do we harmonize rules? How do we combat a race to the bottom, regulatory arbitrage? And how do we enable responsible actors in different jurisdictions to get regulated and to bring these innovations on shore?
Yeah, no, thank you so much, Dang Tae. Time is up, but any last minute things that you want to leave out to the audience today? And to the regulators.
Other than to say thank you to you and thank you to colleagues at the central bank and of course the organizers of today's event for the occasion. Hopefully next time around I will be invited in person if I have not been declared non grata in Thailand.
Thank you so much, Dang Tae. Really appreciate your time and looking forward to seeing you here in Thailand, maybe next year.
Thank you so much.
Thank you.
Thank you.
A big round of applause to all the panelists and speakers today. What a fruitful session to hear all about how digital assets and DeFi are transforming the financial industry. Thank you very much, Dante and Kun Mukhaya, for a very, very insightful and fruitful session on digital assets. So I believe that we see a much clearer picture of how digital assets and DeFi transforming the financial industry, the opportunities and challenges, and also views on future regulations.